Hello everyone, welcome to Deep Dive Finance. These days, a lot of people ask me whether we're close to the next recession and how we should allocate our assets during recessions. Today, I'm going to talk about the first topic. Although it sounds straightforward to understand what a recession means, it is actually not that easy to define it, since we need to define exactly the scale and the duration of economic weakness to be considered as a recession. In UK, a recession is defined as decline in real GDP for 2 consecutive quarters. In US, we follow the definition and classification by NBER, which is a short name for National Bureau of Economic Research. According to NBER, a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Regarding GDP, some people might not know details about it. I will talk about its definition and calculation. People who are familiar with it can skip this part. The definition of GDP, or gross domestic product, is a monetary measure of the market value of all final goods and services produced in a country in a specific time period. For example, when we go shopping, dine at a restaurant, or have our haircut at a barbershop, we're contributing to GDP. There are several different ways to measure GDP. One way is called expenditure approach. Basically, all final goods and services are consumed. They can be consumed by individuals, corporates, the government, or foreigners. Therefore, we can decompose GDP into 4 parts: consumption, investment, government spending, and net export. Then what does real GDP mean? Real GDP is different from nominal GDP in the sense that real GDP is adjusted to make sure it is not affected by price fluctuations. For example, if everything in our economy this year is exactly the same as last year, except that prices are higher, then nominal GDP is higher this year than last year, but real GDP stays the same. Therefore, comparing to nominal GDP, real GDP is a better measure to track GDP fluctuations of inflation across time. Now back to our topic. Are we close to the next recession? It is natural to ask economists who are experts of economic research. Let's take a look at the most recent survey of professional forecasters by Federal Reserve Bank of Philadelphia. The survey is based on forecasts of 39 economists. According to the survey, economists believe the U.S. economy will grow at a slower pace and inflation will be marginally higher in the future. More specifically, we can see from these 2 graphs that they think the probability of negative real GDP growth in the year of 2020 is lower than 10%, and the probability of negative real GDP growth for the year of 2021 is about 12%. For both years, real GDP growth is most likely between 1% to 1.9%. This table shows that according to the survey, the probability of negative GDP growth for the next 4 quarters is increasing as we move forward, although not higher than 25.1% for any quarter in 2020. Another organization called NABE has a similar survey. NABE Outlook survey panelists believe that the U.S. economy will continue to expand into 2020, but they anticipate GDP growth will fall below 2% in the year of 2020. 81% of panelists believe that risks to the economic outlook are weighted to the downside. These 2 surveys show that in general, economists are pessimistic about the economic outlook. They think economic growth will be slower in the short run. In the long run, there is high risk of recession, although they don't think the recession is coming soon. Should we feel relieved at least for now after learning about these surveys? Actually, forecasts by economists are not as reliable as what we think. Let's go back to the most recent recession induced by housing market bubble burst due to subprime mortgage crisis. According to NBER, this recession started from December 2007 and ended in June 2009. If we read the 4th quarter survey of professional forecasters by Federal Reserve Bank of Philadelphia in the year of 2007, as this table shows, we find that economists predicted that the probability of negative real GDP growth for any quarter in 2008 was lower than 23%. However, it turns out real GDP growth was negative for all quarters in 2008 except for the second quarter, and the real GDP growth for the fourth quarter of 2008 was negative 8.4%. The situation was similar before the 2001 recession following dot-com bubble burst. According to NBER, 2001 recession lasted from March to November. In the fourth quarter survey of professional forecasters in the year of 2000, the forecasters expected real GDP to grow at a rate of 3.3% in 2001. In reality, the real GDP growth was 1% in 2001. So for the most recent two recessions, economists failed to give us warnings beforehand. Besides economists, we can also resort to opinions of consumers when we are curious about economic prospects. Because consumption is a building block of U.S. economy, consumer confidence is very important. According to October 2019 survey of consumers by University of Michigan, the growing weakness in their economy is expected to be modest, with 49% consumers still expecting good times in the overall economy during the year ahead. Over the long run, 41% expected an uninterrupted expansion. This is a plot of time series of the Consumer Sentiment Index. We can see that the sentiment index is fluctuating up and down at a high level right now. Another index called Index of Consumer Expectations is designed to capture more information about consumers' prospects and expectations about the general economy in the future. If we compare these two indexes as shown in these two figures, we find that they are very similar to each other at any point of time. This is not surprising. Although the sentiment index focuses on current situations, and the index of expectations is supposed to focus on expectations and predictions, it is very hard for consumers to feel too pessimistic about the future if their current confidence level is high, or feel too optimistic if their current confidence level is low. Are consumers more knowledgeable than economists in predicting recessions? October 2007 survey of consumers by University of Michigan shows that although consumers were pessimistic about economic growth, they did not expect a surge in unemployment rate. However, the unemployment rate was as high as 9.3% in 2009. Similarly, October 2000 survey of consumers said that most consumers believed it was more likely that the economy would improve rather than worsen during the year ahead. Therefore, the recent two recessions were not expected by consumers either. There were two cases that the consumer indexes dropped significantly before recessions, which are the recession starting from end of 1973 and the recession from beginning of 1980. Why these two recessions were expected by consumers? I think the reason is because there were very obvious market signals before these two recessions. As we can see from this stock price figure, before the end of 1973, the stock market already started to crash. Before the beginning of 1980, inflation rate was higher than 10%. In both scenarios, consumers were extremely pessimistic. Therefore, it was not a surprise that recessions were on the edge. Now let's take a look at what other indicators can be used to predict recessions. Some scholars find that U.S. Conference Board Present Situation Index year-over-year change turns negative by more than 15 points before a recession. The only time the signal was a little bit late was 1982 recession. In all four of the other post-1980 recessions, this signal turned negative just before the recession began. I believe there are cases when the signal turned negative but no recession followed. However, I don't have exact counts of false alarms based on this signal because the data is not public. Another important index is CFNAI, Chicago Fed National Activity Index, which is a weighted average of 85 economic indicators. Let's take a look at the time series of the index where recessions are highlighted in shaded areas in this figure. We can see that during recessions, this index drops below 0. When recessions are close, this index tends to drop below 0.2. Unfortunately, there are quite some cases when the index is below 0.2 but the recession was far away, especially when economic expansion has long duration. Given that we are now in the longest economic expansion without interruption since the year of 1857, this index does not contain much information in predicting the next recession. Actually, quite a lot of people worry about an upcoming recession simply because the current cycle of economic expansion is too long. It has been 125 months since the end of previous recession. However, there is no solid theory to support this conjecture. According to NBER, the longest economic expansion in history, excluding the current one, was 120 months, from April 1991 to March 2001. The second longest was 106 months in 1960s. The third was 92 months in 1980s. Anyways, it is true that we are now in the longest economic expansion in US history, but nobody knows when the party is over. Another commonly used indicator of recessions is inverted yield curve. It is claimed that when the yield of long-term treasury bond is lower than the yield of short-term treasury bond, there is high risk of recession. We usually use 10-year treasury rate to measure long-term yield and a 1-year or 3-month treasury rate to measure short-term yield. In most cases, long-term yield is higher than short-term yield because there is higher risk and more uncertainty in long-term securities. However, when investors are worried about the economic outlook, they tend to invest in safer assets and stay away from risky assets such as stocks. In the meantime, investors expect that interest rates will decrease once a recession starts because the government usually lowers interest rates to stimulate economic growth. To lock in higher returns right now, investors will invest more money in long-term treasury bonds, which pushes the long-term treasury rate down. Some scholars even go one step further and try to argue that there is causality relationship between inverted yield curve and recessions. According to them, when yield curve is inverted, it is less profitable for financial institutions to lend, so they will decrease credit supply, which eventually causes recessions. In general, inverted yield curve is a reliable indicator to signal recessions, although it is not 100% accurate. For example, the yield curve was inverted around 1967, but the recession was far away, which did not start until 1970. Another point I want to highlight is that although there is usually a recession after the yield curve is inverted, it is hard to tell how long it takes from inverted yield curve to a recession. It can be several months to several years. Therefore, the information from inverted yield curve alone is limited in predicting recessions. Another indicator related to recessions is unemployment rate. From this graph, we can see that there is unemployment hike during each recession. Right before each recession, unemployment rate is usually very low. Unfortunately, because it is very hard to predict unemployment rate, it is hard to predict recessions based on unemployment rate alone. The very last indicator I want to discuss about is stock price. Usually, there is significant stock market crash before recessions. However, it is not always true that when stock market crashes, a recession follows. Therefore, it is impossible to predict recessions just using stock market information. For example, we can see from this figure that there was significant stock market decline before the 2001 recession, but there was no significant decline before the 2008 recession. Stock market crashed after 2008 recession already started. Most people would wonder why economists cannot come up with a synthetic index to help us predict recessions, given that we have so many useful indicators, although none of them can be used alone. Actually, the CFNAI, Chicago Fed National Activity Index, is a good example that economists try their best to do the job. This index is based on 85 economic indicators, so it should contain enough information about recessions. Unfortunately, predicting recessions is naturally hard due to the following reasons. First of all, we have a very small sample of recessions. According to NBER, there are 33 recessions in US history from the year of 1857. Given that some economic data was missing, there are even fewer recessions which we can use to analyze business cycles. Even if we find a perfect index to accurately predict all historical recessions without giving any false alarms, it still takes time and more recession scenarios to test its reliability in the future. Secondly, the government can use monetary and fiscal policy to stimulate the economy. Even if we find a reliable indicator, it is very likely that when the indicator gives recession signal, the government steps in to fight against a potential recession, which makes a recession come later than what the indicator originally predicted. This complicates the relationship between the indicator and the recessions. Now let's come back to the question that we are most concerned about. When the next recession will start and how long it will last. Unfortunately, nobody knows the right answer. If someone tells you that he knows for sure that the next recession will start at time A and end at time B, and it turns out that he's right, all I can say is he's just lucky. In terms of recession start time, I think the probability of a recession starting in 2020 is low. Here is why. If we take a closer look at time series of CFNAI, Chicago Fed National Activity Index, we can find that right before each recession, the index level can go as low as minus 1.07 or shoot as high as 1.27. So there is little information in the level of the index. However, there are some patterns we can observe from this figure. Before each recession, there is a very obvious decreasing trend of the index from its peak during the expansion period. The index usually drops by more than 1 point within 1 year. We have not seen such a steep decline of the index in our current cycle yet. Another takeaway from this figure is that higher index peak in expansion is usually associated with longer expansion duration. The only exception is the expansion from end of 1982 to mid of 1990. Given that after the end of the last recession, the index is never higher than 0.55, it is not surprising that we are in the longest period of expansion. Another reason why I think the probability of a recession starting in 2020 is low is because of presidential election in November. According to Wells Fargo's research, in the past 70 years, economic situations in election years are not significantly different from the year preceding or following them. Election years even exhibit higher rates of growth and investment. If this time is not different from history, the probability of significant economic deterioration in 2020 is low. Although we are not sure when the recession will start, there is one point I think we are sure about. That is, once we hit the next recession, it will take longer time than before to recover. The interest rate level is already very low, so there is little room to lower interest rates to stimulate the economy once a recession starts. The government can increase expenditure to speed the recovery, but given the current level of government debt, it is not easy. Considering not very promising economic prospects in Europe and Japan, there is little positive spillover effect from global economy. Okay, this is the end of today's discussion. Thank you for watching. See you next time.